All right, guys, good afternoon. Let's get this started a minute early so I can get through the disclosures. Uh, on the travel computer setup again today, so I hope I sound okay. I know sometimes the sound on this microphone that I have here isn't the best. Hopefully it sounds okay on the YouTube also. Cool. All right. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There is the current position disclosure for my overnight positions. All right. All right, let's jump in. Just a reminder for everybody in the virtual trading floor, I'm live here in Charlotte. So you guys like Charlotte, right? You guys are from here. We can live from Charlotte. Cool. First time here, first time in the state, so definitely excited about that. I'm gonna be doing our normal afternoon meeting like I always do, but for the people in the virtual trading floor, I might get into a little more depth on some of the stuff that we're always talking about, just in more detail, even though you guys know how all this works already. I've got some new guests here, and I don't know how much they know about how we trade. So I'll try to be a little bit more in depth on stuff and a little bit more educational on some stuff as much as I can. And for anybody who's new on the teams, a few of you guys, it might be a good opportunity for you to learn a little bit about some of these concepts also. So let's start with our usual recap. How the market closed today. SPY is up about 0.25%. Sure, felt like a lot more than that. Q is up about 0.4. The Russell's up small, relatively weak on the day, up 0.14. TLT here is up 0.3%. So bonds up, interest rates down. The dollar's pretty flat. It's still within the range that it's been in for all of August and September. The EUP ETF. Gold closed flat but made new highs today. Oil down again 0.8%, also still within a couple month range that it's been in. Quick look at crypto. Bitcoin up 2.7%, Ethereum up 4%, SOLZ Solana ETF up 6%. This is one of the first things we noted today was that crypto was gapping up pretty nicely and it could indicate risk on. So start with a little bit of a recap of the day today. Um, Government shutdown today. So you might think that's not good, but traditionally the stock market doesn't really care about that. So that's what we know. What's different about this, and Greg M, if he's listening, or even it might even be here, um, provided some good statistics to the team this morning about what happens market wise with government shutdowns. And I thought it was really good information because everybody seems to be showing the same statistics about government shutdowns. I've traded through a few of these 2013, 2018. Um, Usually, when we go into a government shutdown, it doesn't really have an impact on the market. The market moves up, actually. And especially when the resolution happens, the market moves up. But what's different this time, which I think potentially skews those statistics that everybody's talking about, is that usually the market sells down into the shutdown. It's like the expectation that the shutdown is coming causes the market to sell down, and then when the shutdown actually occurs, we usually stop going down. This time around, unless you count the tiny baby pullback that we had last week as the sell off into the shutdown, there was no sell off into the shutdown because there's been no sell off on literally anything since we bottomed in April. This has been the strongest bull market I've ever seen over the course of my career. Not necessarily just in terms of the percentage that we've moved up, but the fact that there has been no ebb and flow. We have not had more than a 2-day down move since the April low. We've barely even had that. I don't think that we've had a 2% pullback in over 100 days or something like that. I mean, this is literally the strongest market I've ever seen over the course of my career. Whether it's healthy or not is a completely different conversation. But anyway, snapping back to this morning and this morning's game plan, um, we were gapping down, and if I bring up the pre-market chart, we were down. I woke up way too early this morning. I got up at like 4:15. Pre-market trading starts at 4. When I got up, we were down like 0.75%, 0.8%, which actually, if we would have just opened where at the pre-market low and stayed down there, it would have been like one of the biggest down days we've had since April. But of course, that didn't happen. By the time we were doing our morning meeting today at 9 a.m., the market was down 0.4%. So it had recovered half of the pre-market loss. And then within us, 15 minutes of the market opening, we were almost working on a gap fill, had that quick pullback on the Ukraine news when it hit, the nuclear reactor in Ukraine that has only 10 days left of diesel gas before a nuclear meltdown happens. So, I mean, that's a classic piece of news that we've been like a smart piece of news that we've seen for months now, where the market goes down for literally 5 minutes on potential nuclear meltdown before then making new highs. Then we went green, and then we trended up pretty much all day today. So circling back to the morning meeting, because I always like to compare what our assessment was in the morning meeting versus what actually happened during the day to kind of keep us honest. And obviously we usually do a pretty good job with that. Kind of presented two different possibilities for today's trading session. Possibility number two, I'll say first, because it's the one that happened. Possibility number two for today was market is gapping down on a government shutdown, but government shutdowns, they don't historically bring the market down. Everybody views this as just the next dip opportunity to buy. We don't even call these dips anymore because the market doesn't dip. We call them blips. These little baby, 0.25% pullbacks that are instantly bought in this market just because that's how the market's been behaving these last handful of months. Um, everyone recognizes the same data that everyone has been sharing, which is markets don't go down in shutdowns. They view the 4.4% gap down as the next buying opportunity. They buy us back, and we continue. That was one of two plausible scenarios we presented in the morning meeting, and that's exactly the scenario that ended up happening. The other scenario, and I think it's worth repeating because it just dives into the conversation that we love to have about market dynamics. The other plausible scenario was one, the market usually sells down into the government shutdown, and that didn't happen this time. So it's potentially a little bit of a different playbook than the previous shutdowns that I've experienced. And two is from a market dynamic perspective, we understand right now that the positioning risk in this market is very, very much to the downside, but only if selling can actually be forced. And there's a number of ways in which selling can be forced. But the first and foremost that could have hit this market down today would have been from the vol control systematic community that we like to pay attention to. So we had the data here in the virtual trading floor this morning that basically showed, I could try to like look up the graph really quick in the virtual trading floor if I could find it. But just going off the top of my brain, if the market could go down 1% today, then the vol control systematic community, I think, would have been forced to sell. I'm going to look up the number so I don't misquote it. I don't remember now if it was $17 billion worth of stock or $8 billion worth of stock. Scrolling all the way up here in the virtual trading floor to like 8 a.m. when it got posted. All the data and information that we have in here, which is all great. Talk about that a bit. There it is. So looking at this graph, which I can't share on this screen that I'm sharing with everybody in front of me, or I would. On a 1% down move, eyeball on this graph, it looks like you probably would have had about $8 billion of forced selling to come from the vol control systematic community. That accelerates very quickly. If you could have gotten to 1.5% down, then you would be probably at like eyeball on this, like $18 billion to sell. And then just talking about the continuation of the acceleration, if you could have had a 2% down move today, you would have been met with about $47 billion of additional selling from the vol control systematic community. So the other plausible scenario that we discussed was, hey, the market's gapping down 0.4%. Pre-market, it was 0.8%. At 0.8%, a quick momentum downtick off the open because we're breaking below SPY support at 662 could have you down a full percentage point, and that's met with an additional $18 billion worth of selling. And that is something that can eventually begin to feed on itself. So, um, going back to the market here and looking at where we were set to open down about 0.4%, obviously we immediately ripped right in the beginning of the day. But if you could have been met with any selling, if you could have gotten down to that pre-market low, that could be the beginning of the first trigger to actually force selling. And this is why our understanding of market dynamics is so important. If you can, to take a step back, because I've got some guests here, what is technical analysis? Technical analysis, quite simply, is the study of supply and demand in the marketplace. Most people, when they think about technical analysis, they automatically assume charts and charting, and that's not wrong. That's not wrong at all. What we're doing when you are a technician in the marketplace is you are studying the chart patterns to assess buying and selling to try to predict how that buying and selling can impact future price to be able to make money from it, right? That is the traditional thought process behind technical analysis. So, technical analysis, again, is the study of supply and demand in the marketplace. But when we're looking at this information that is being modeled that we're able to get from Goldman Sachs and Nomura, Bank of America to some degree, Citadel, and they are telling us if the market today, based on a systematic, like, I don't want to say systematic system, but based on the systematic process of the market, right? If you're running an algorithm, it's rules based. If something is rules based and it's managing enough money, you can just analyze and model out what the rules are to know in a given market situation what these funds need to do in those situations. So modeling it, vol control today, if somehow the market went down 2%, would be forced to sell an additional $47 billion worth of S&P. That is something that creates a potential feedback cycle, a knockoff effect into other things. That is actually the essence of how trend works. All a trend is in the marketplace is basically a feedback loop where buying leads to more buying, that's an uptrend, or selling leads to more selling, and that manifests as a downtrend. So when we think about the concept of market dynamics, I actually consider it, I don't know if anybody else in the whole world does this, I might have been the first to do it. I consider this aspect of market dynamics, understanding vol control funds, understanding the gamma level of the market, understanding the CTA trend following funds, how much money they are modeled to buy or sell in any given situation. That is a subset of technical analysis that in one way is even easier than analyzing charts, and in the other way is significantly more difficult. It's easier than studying charts because I'm literally telling you what the number is. It's more difficult than just studying charts because some of this stuff gets really, really deep in the weeds trying to figure out exactly how it all works, how it's modeled, does it matter, things like that. So we know in this market right now with how it's been moving, the risk is to the downside, without a doubt. Um, we know with the vol control funds. Separately, we saw, and I have it here somewhere, the latest update from Goldman Sachs from 2 days ago from their research note. Give me one second. I can actually pull this one up. Here it is. We know from this latest Goldman note, from the CTA like trend following community, and I mainly focus on the U.S. because that's what I trade. I trade the U.S. markets. In a flat tape, the systematics are buying $1.16 billion worth of stock in the S&P in the U.S. That's nothing. In an up tape, they buy even less. They're buying virtually nothing. In a down tape, they are sellers, and that's just over the course of this week, of $6.75 billion. So a little bit over a billion a day. Over the 1 month is more dramatic. In a flat tape, they buy $2 billion over the course of a month. It's meaningless. In an up tape, they buy even less than that. But in a down tape, if the market can sell down and then here's some of the models of that, they would sell $77 billion worth of stock. So again, the risk is to the downside, and it goes back to the Scott Rubner quote from Citadel that I have been quoting nonstop for the last month or so, which people conceptually don't seem to understand, which is if you can go down a little, then you could go down a lot, or you probably will go down a lot. But the thing is, the market has to trigger some of this stuff, right? If the market can't go down a percent today, you're not going to get the $8 billion worth of selling. If the market can't go down the one standard deviation amount over the course of this week or this month to trigger the selling from the CTA trend following community, you're not going to get the selling. If the Nomura model on the leverage ETF rebalancing says it also shows risk to the downside, if the market could go down 3%, not even in one day, from highs to lows, could be over the course of multiple days, it's going to be met by $90 billion worth of selling from leverage ETF rebalances. All of that is risk to the downside, but it has to trigger. And on top of that, back to the Citadel note from Rubner, we know that funds are massively short the VIX right now. If the VIX could squeeze, then you could get an entire short squeeze out of the VIX, which all of this just has a like a domino effect on the market to the downside. That's what creates the bigger sells. That's what creates. This is my favorite. I think I pulled it up somewhere already before this meeting. This Charlie McElligott Nomura um, slide that I've saved and I've made my backdrop on my computer, which is what we call the conditions for a crash. The conditions for a crash are basically here, but doesn't mean that it has to happen. It only happens if it actually gets triggered. But knowing that the conditions are there in and of itself, in my mind, is enough to be very weary, if that's the right word, of pushing for additional upside with the market. With all of that said, the old saying the trend is your friend is so true. We have seen periods of time where the market dynamics are lined up where there's a lot of risk to the downside, but the downside doesn't trigger for weeks or sometimes even a couple of months. So this is not a timing tool, it's information to be wary of, though it certainly helps to know that like the CTA sell triggers at 6,500 right now for the trend following community, because you know if it triggers, you know how important that 6,500 is. Um, so we have seen periods of time where this market can continue to grind higher, move higher, the trend is your friend, and work its way up. And the systematic community is not the only community of flow of funds that exists, right? You've got your hedge funds, your long short funds, you've got corporate buybacks themselves, the largest source of demand in the stock market these days. You have, the market maker gamma profile becomes really important. The interesting part about where we are right now at the end of September and the beginning of October is that this is what we call the window of weakness, right? Because after September OPEX, roughly, we lost a lot of that positive insulating S&P gamma, and um, we are also now heavily in this corporate buyback blackout window. So two of the largest sources of demand from August that helped to hold the market up in August, corporate buybacks and market maker dealer gamma, are not actually present right now. So it would make it even easier for the market to go down to trigger the systematic selling right now than it would be in August or in June or July. But I still can't force it to actually go down. And the bull side of the market, the bull side of the argument is that sentiment has still been super low. And when you look at that Goldman Sachs like positioning sentiment indicator that they have, it's been negative for now the third longest stretch in the history of them keeping it. That is representative of the fact that the funds that are out there, the discretionary funds that are out there, they're the ones that are not in the pool. And that's the biggest difference between where we sit here in the beginning of October versus where we sat at the end of February this year when we were calling as the market, and this is why like I'm a technical analyst, I believe in technicals, but the, us as a team for the people who are guests here, when the market made all-time highs on February 19th, if all you know is technical analysis, this looks so damn bullish. Look at this beautiful pattern here, a multi-month consolidation in the market that is breaking out to new all-time highs, set for continuation. The measured move here, 5,800 to roughly 6,100, should be like $300 to the upside. This measured move on this break of like $6,100 should be giving you a move up to like $6,400. That's what every pure technician that I know, got a lot of friends who are successful, who are just 100% pure technicians, were buying this breakout here on February 19th, looking for the move to 6,400 as that measured move. And we were yelling that you can't buy this market and you need to be shorting it. And then that was it. This was Feb OpEx. Not a coincidence. Not a coincidence that the sell off began on Feb OpEx at all. There was no change, by the way, between February 21st, when the biggest selling started to happen, from like a macroeconomic, fundamental, or political, or tariff, or anything. There was no difference on February 21st compared to February 13th. The only difference is that that was OPEX. And then OPEX created a change in the market dynamics that actually allowed the market to move down. Because in order for the market to move down, in order to get the when crash dynamic that we discussed, you not only do you need all of the positioning and market dynamic stuff to be fully in place and fully intact to actually enable the market to go down, but it has to be a combination of the timing of an event hitting with the desire from the market to actually sell. And that's what you had back here in February. And what you also had in February, and this is why I even brought this up, my brain's all over. Um, what you had in February that you don't have now is that the hedge funds were long at the 97th percentile, and they're not here. They're not here. And that's what's been so hard about this market. That's what I was talking about on my podcast thing today with JR and Sammy. The hardest thing about this market trend right now is if you've ever been educated in finance or economics, you can't get yourself to like buy this market. Like forget about technical analysis. This is why technical analysis is so important, right? This is why we say only price action pays. Study the stock market, listen to the message of the market and the price action, and not necessarily all the news about the headlines and the fundamentals and everything else. But if you've ever studied economics, what do you know tariffs do? Tariffs are stagflationary in nature. That is like economics 101. And you're scratching your head about how come the employment situation is deteriorating and prices are moving back higher, but this market is making new highs every single day. And that's why you can't pay attention to that. That's why you have to pay attention to what is the trend, what are the market dynamics, are they set up in such a way where there's risk to the upside or risk to the downside. And again, to circle back to the beginning, we know that the risk is to the downside if it can trigger. So when you go all the way back to this morning had a tremendous amount of potential for bears. And that's why we presented one of two situations for today. Situation one, very straightforward, and it's the one that happened. Everyone knows that government shutdowns really don't impact the stock market. We did see some good information that Pat provided yesterday from, I forget which research report it was. It said if the shutdown lasts more than 2 weeks, it could begin to have a broader sustaining impact on the stock market and the economy. But generally speaking, everyone knows what happens here. Unfortunately, the government workers get furloughed. They don't get paid right now. The essential workers have to continue to work even though they don't get paid. But then everybody gets their money as soon as the government's up and running again. And you might lose a little bit of GDP on the forward side, but you make it back on the latter side, and everything is hunky dory, and it's not a big deal. And if anything, I would argue that if the government, these people in government, get a deal done very soon, there's a big risk to the upside because you'll get a Vegas squeeze in this market from the VIX coming back down. Though the VIX did actually trade back below 16 today, it was above 17 at a certain point. Most likely, if all of a sudden a deal gets announced tonight or tomorrow, the government's going to reopen. People are going to be unwinding their government-related shutdown hedges. The VIX is going to be back below 15, and that'll actually inherently create the next squeeze higher in the market. So that's the scenario that played out. But there was this other plausible scenario when we were seeing the market down 0.8% pre-market, like, oh man, if we could get below 662 support in the SPY from yesterday, which held 10 times between the pre-market and the intraday, 10 times. Traditionally, for people who don't know, there's a very logical saying in technical analysis that every time a support level gets tested, there's a higher probability that it breaks. I can explain the supply and dynamic basis behind that, right? You have what is support? Support is an area of basically underlying demand in the market. But every single time you test that support, you're eating away at that demand. And eventually, if those sellers are able to test that support enough times, you've eaten away all that demand. It's gone, and you get a breakdown. We had 10 tests of 662 yesterday between the pre-market and intraday, roughly. We had another test of it pre-market this morning because we gapped below it initially at 4 a.m. and it held it every single time, and then it ripped this market higher today. So yeah, just incredible strength from this market. My personal thought process as far as my approach right now remains the same. I can't get myself knowing that the risk is so greatly to the downside. I don't think it's impossible. I'm not saying this is going to happen. I don't think it's impossible right now to wake up to an August 2024 situation where all of a sudden you get that massive VIX spike with all the funds being short that causes a knockoff effect of huge vol control selling into huge CTA trend following selling into ETF leverage rebalance selling as the VIX is spiking all at once, where you get one of those brutal 3-day sell-offs, and then maybe that's it. Actually, it could be the dip to buy, but that keeps me away from entering new bigger picture longs, anything more than a day trade right now. But if you're trying to short this market, you're fighting an upside grind trend, and those are the worst ones to fight. So if you're trying to short this market, you need to either try to short it on the way down when support levels are breaking. I can't remember the last time a support level broke in this market. Or, we've been able to pick our spots for some cute shorts throughout the day. We had a short call out off the third bar of the day today. It was a cute little trade for a quick pullback. We had a short call out off the 1035 high today. Same deal. You got a cute little pullback off that. The game plan remains the same on these. These are counter trend trades that are most likely going to fail because counter trend trades tend to fail. So you take those trades not with a massive amount of risk. You get your risk covered on it pretty quickly. You book some profit into the 80 EMA. You book some profit into the 21 EMA if you get it. And then maybe if you want, you hold 10 to 20% of your position as a core just in case the retracement lower actually becomes a reversal. And by luck, you somehow catch a top. We don't try to pick tops in the market. We try to pick spots in which there is a higher probability of a retracement. But we like to have rules in place whereby the retracement lower can turn into a reversal if things were to become a reversal pattern and actually work their way down. And if you do get that, even on that 10 to 20% of your position, even though it's lower probability, you could get really high asymmetric risk reward out of it. So picking some spots for some cute shorts on the way up makes sense. Buying, breakouts and continuation trades, especially in some of these crazy meme stocks, for day trades makes sense. But if you're looking for the bigger picture short right now, for the bigger picture pullback, for the break of everything we just discussed on a market dynamic perspective, you got to be shorting this market on the way down when it shows you that things are actually breaking, and not trying to pick this top because, like I said, all the market dynamic information shows us that the risk is to the downside, but that's not a timing tool, right? I can tell you someday it's going to trigger. Every time it triggers, eventually, when we get to this point, it triggers every time. But sometimes it triggers after a couple of days. Sometimes it takes a couple of months for it to actually trigger. But just knowing that that exists, because that didn't exist in May or June, you did not really have that asymmetric positioning risk to the downside or July, right? In this period, if you guys remember, we were looking at the vol control funds and the CTA trend following funds buying, you know, billions of dollars of stock every single day. They're the ones that supported this market. And this will be the last point I make about this because I love, I've always known in my whatever it is now, 17 years being a professional trader, that the trend is your friend, right? That's like the first thing you learn when you start doing technical analysis. The trend is your friend. Be a trend follower. It really is the easiest and best way to be able to make money. But what I've learned over the course of the last 5 years, since I've really started to dive more into this market dynamic information, is actually what causes each aspect of the trend of that feedback cycle, right? And we all know what this has been. This started primarily as systematic buying to the upside because at the April low, they had sold as much as they had ever sold, right? They were all net short and they could only buy at that point. And we were able to be reading every single day, all right, the systematic community is going to be buying 5 billion today, 10 billion today, and there was an underlying bid on this market that could never release. By the time we got to August, that buying it didn't go away, but it started slowing down significantly. But you began to see at different parts on the way up other cohorts being stepped in and being forced to buy. And the most recent of that now is this under-owned hedge fund community. That's still the one part of the puzzle, the flow of funds puzzle, that is left to buy in this market. They have been underexposed to this rally. They've been too short into this rally. And that's why this later part of this rally has been characterized probably by short squeezes as much, if not more, than new long buying that's been coming in the market. And that's why you've been seeing all these crazy BS companies that are pre-revenue companies that probably belong at a quarter of the price that they're trading at, whatever belong means, just continuing to squeeze up, basically every single day. So it's kind of just a quick synopsis of what our game plan was for the day, um, how it played out. Obviously, beautiful trend day today. Really, really big move, especially if you go pre-market lows to the high of the day today. And when you look at this daily chart, we're not extended, right? We're $5 off the ADMA on the daily chart for the SPYs. There's no real extension of the upside here to speak of. This market looks technically fully intact. And we had noted the challenged trend from last week, right? Two equal lows we refer to as a challenged trend. An uptrend's a pattern of higher highs and higher lows, right? So why is this an equal low and not a higher low? That's what we call a challenge trend. Something's a little bit wrong. The buyers weren't as strong as they had been previously, or sellers were stronger. That's how you're getting these two equal lows as opposed to the next higher low. That does not mean that the trend is breaking. It's just something that you take notice of. We took notice of these two equal lows that we had gotten, and the question was, okay, uh, particularly for Monday of this week, does Monday create a lower high that then goes after the equal lows and this challenge trend meant that we're rolling down here? Or do we just get a new high and then, all right, you had two equal lows, but it doesn't matter. The uptrend is fully intact and we get continuation. And now we have the answer. We got new all-time highs today for the SPYs. These equal lows is now just trend continuation. We got new all-time highs here for the Qs. Qs never quite gave the equal lows, but this is just further trend continuation. And the IWM is a little bit messier. It's still kind of building out a bit of a bull wedge. So that's all I have at the index level. As far as the individual stock level goes today, on a day like today in particular, I'm very, very top-down focused. For me, it was 100% about going from the index level first and then working our way down. But we did note the Apple relative strength in the beginning of the day today, but it faded super fast, which is interesting because in the beginning of the day, it seemed like Apple was what was ripping this market up, and then you had no continuation from this for the rest of the day. Nvidia was the opposite. Nvidia looked like it was the one thing that could drag this market lower. The 184 to 185 is what we discussed in the morning meeting is the really important level for NVIDIA to hold. We noted the relative weakness. Look, it held that 184 perfect. So held that 184 support level and then turned into helping to buoy this market higher. Um, but once again, it was Micron. It's the floppy disk names, as we like to joke. Micron up 9% today. STX up 9% today. SanDisk up 8.5% today. LRCX up 7% today. AMAT up 6.5% today. It's really just like the next leg of the rotational part of the AI trade going into these stocks that is really ripping everything higher, even when a lot of the Mag 7's not trading as well, right? Like Apple's pretty good on its daily chart, but did it close there with that tail? Yeah, that's kind of gross, actually. This thing should have given bullfly continuation today and had every reason to with the market closing on highs and it closed with this upside tail. I'm not willing to short this pattern, but I would pay attention now to the old saying a failed move becomes a fast move. If this Apple starts to lose like this 252 area, one of my favorite signs in the market that I like to pay attention to is basically when a stock should do something and it doesn't. For example, if stock has really good news and it can't go up on it, a lot of times that's a signal for the other way. Apple should have went today, and it didn't. And this is one of the more bullish Mag 7 charts that's out there right now. That seems like there's something a little bit wrong. Meta is disgusting. Meta, if anything, needs to have an oversold bounce at this point. I think it had it a little bit off lows with the market doing what it's doing. Meta is not participating at all. Um, Amazon is kind of gross. It had a bounce back day today. I mean, try to find me something that didn't have a good green day today, considering how strong the market was. Amazon Mag 7 stock, big picture here, is not participating. If anything, you could say this is making a bearish consolidation pattern right now. Uh, what am I missing? Microsoft is still sloppy as far as I'm concerned. This is very much within a range. It might be improving. This thing's starting to get above like 517 to 520. This chart is starting to improve, but this is another one. I mean, just look how far off its all-time high it is. And remember, this was one of the best earnings reports of all of earnings season. My not so joke has been the only thing that can make a stock go down right now is reporting great earnings because it seems that way. Microsoft reports a great earnings report and it can't continue. Micron, I know it ripped today, but when Micron reported earnings on the 29th, on the 24th, this thing couldn't stop going up until it actually reported phenomenal earnings and pulled back for 3 days off of it and then continued. But anyway, back over to Mag 7. And I would even argue so Nvidia chart looks beautiful. We called the breakout yesterday. It was a great trade. I'm glad that people participated in that breakout. I know Brant was all over that for us in the virtual trading floor, but it didn't really go like the Nvidia of old either. And that's the other thing that we've been kind of noting. This isn't a chart that I want to short by any means, but the Nvidia of old. Remember when I bought? Oh man, how long ago is this now? And I think it's split adjusted probably multiple times. Yeah, there it is. When we bought, I think it was 500. They did a split. I'll zoom in and look at the chart pattern. Um, this break here of $50, I think it was 500 at that time. At the very beginning of 2024, you had this multi-month consolidation in Nvidia, and then it just broke through this 50, and we were buying that breakout. Like, look at how this name behaved after that. Look at the strength and the continuation. Even yesterday, when we were watching Nvidia break through 184 and 185, it just it you can look at this chart in any way and say it's bearish, but I would certainly argue it didn't go with like the traditional Nvidia momentum that we normally see. It's almost like a little bit suspect. I would never short a chart that looks like this, but I'm keeping in the back of my brain that if God forbid this market ever pulls back for more than a quarter of a percent in a single day ever in the history of the future of mankind, that Nvidia could actually end up being a failed breakout here as well. And that's one of the best. That's the other one of the charts. It's like best looking of Mag 7. And then you have Tesla, and Tesla did go today, and we called out Tesla for a long in the morning meeting today, by the way. So I hope somebody caught that. Beautiful continuation on Tesla, another beautiful bull flag. Retested the 80 MA on the daily chart yesterday. I was a little concerned. It shouldn't have been as weak as it was yesterday, but I think that was just end of quarter rebalancing that was impacting the stock. So yeah, anyway, I think that's a good recap of today's trading session. Some of the stuff they were looking at. Oh yeah, Tesla's reporting their car numbers tomorrow, but they're not a car company, so it doesn't matter. We'll see what those numbers look like, and it'll bring the stock up no matter what. Yeah, they're a robot company, a battery company, an AI company. They're anything but a car company. All right, that's all I got. Anybody here in the VTF have any questions? I'm gonna do questions for the live audience, but I'm gonna end the afternoon meeting before doing that. I'll just answer any of your questions now, though. If anybody's got anything here, scrolling up in the VTF to see if I missed anything. Doesn't look like I did. So yeah, we did have XLF down today, which is interesting. And XLE was weaker also. But yeah, financials were down. KRE was pretty weak at certain points, and the IWM honestly wasn't fantastic today. And no new highs there yet. And obviously that's heavily impacted by having KRE trades. But the XBI breakout continuing. IBB, beautiful, beautiful breakout continuation. All right. Well, looks like you guys are being shy today, probably because I have an audience here in front of me. So I will end the afternoon meeting for the virtual trading floor. I'll see everybody tomorrow morning. Have a great night.